While we're talking about President Trump, though, it would be hard to really overlook the fact that he's been putting a lot of pressure on the Federal Reserve. And the Federal Reserve itself is paying close attention to how its interest rate policy impacts other countries. Despite President Trump's push for the central bank to maintain an America-first monetary approach, Brian, you were just in Jackson Hole and have been closely monitoring the Fed's response to that and the Fed's actions, of course, ahead of that September rate decision. How do you think that it's playing in, though, as they continue to kind of look at the global slowdown and then here at home, where things have held up so far, if you look at the data, what their thinking might be moving forward?
Yeah, well, I mean, that was the overarching theme from Jackson Hole was really about whether or not there should be more coordination on monetary policy from the central banks around the world. But that's a complicated question when you consider the fact that here in the U.S., the Fed's dual mandate is entirely domestic. It's stable prices at home and maximum employment at home. But what we're seeing is that in this interconnected global financial system that we have right now, what the Fed does as the largest economy and the largest central bank in the world has an effect on other countries as well. So one example being the strength of the U.S. dollar and just the crazy inflows that we've seen into U.S. government bonds. I mean, you've seen what's going on with the yield curve. A lot of that is because of all duration. There's so much inflow and investment into U.S. government bonds. Some of that is because of the fact that the U.S. has a higher interest rate than other countries around the world. That is a point that President Trump has harped on. Hey, why does the Fed have higher interest rates? That's making a dollar stronger. That's making it hard for us to export to other countries. But the central banks are saying we're not prioritizing the short-term changes in where the U.S. dollar is, but we do need to be mindful about what the long-term impacts are of all these assets and all these capital flows coming into the United States, which is why they're focusing on, hey, maybe we should have a global perspective when we make our monetary policy as well, which runs counter to what President Trump has said, which is let's weaponize our monetary policy to fight China and win the trade war. So a very, very different kind of rhetoric there. And
also, I mean, as we're talking about this, too, you got to keep in mind that $15 trillion worth of negative yielding bonds exist out there. And we just saw, when we look at Germany, the move there as well, because they sold the first negative yielding 30-year bond note, and other nations like Japan and France, as you mentioned, wading into further negative territory. I mean, when we talk about that, I don't know if this was brought up in Jackson Hole. Clearly, the president saying that Fed Chair Powell is an enemy on the scale of China was kind of rattling, I'm sure, out there as well. But the idea that negative interest rates could eventually come here in the U.S., that's something that Jay Powell has said he doesn't foresee as a policy tool, but that could change.
Yeah. Absolutely. I mean, it's a real possibility. All the central bankers in Jackson Hole were basically saying, we have interest rates at about half the level they were headed into the financial crisis. So if we hit something as severe, or maybe not even as severe, it's a very likely possibility we get back down to zero again. And in that case, does the Federal Reserve decide to do quantitative easing again, or do they try to go into negative territory as we've seen in the ECB at the Bank of Japan? The problem here is that negative interest rates aren't necessarily the same as negative yielding debt, right? So you talk about the 30-year German bond, that is in negative territory, but we have to remember that the Fed could get down to zero interest rates and markets could still price, because again, it's the markets that determine where the yield is trading on a bond, could actually press it below negative. So it's possible that we can get negative yields on a US 10-year, on a US 2-year. If the Fed gets back to zero, it doesn't need to go negative. But if that were to happen, that would raise huge questions about what the monetary order looks like when your risk-free rate is negative. That's a real issue when you're trying to model what the proper value is of other types of yielding assets.
And as we talked about, if you get there before we actually enter a recession, what policy tools are still left to kind of help if we do see things?
I don't think you can equate global policy versus U.S. policy to your earlier statement. I think that's a naive move on Trump's part to say, oh, well, we should be considered a world bank. And, Japan's had negative interest rates for a very, very long time. I don't even know if U.S. bankers or kind of the local environment will understand how to implement that,
Especially if, when we're talking about mortgage rates being tied to all this too, what it would look like if you have people who are in homes with negative interest rates as well. Very, very confusing and weird, untested, untried territory we're moving into here.